Welcome to our Taking Stock video for the week ending August the 9th, 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to discuss all things share markets. How are you, Jace?
Very good, Ken. It's been a pretty interesting week in markets.
Yeah, quite a volatile week, Jace, and reporting season's also upon us as well. And it's going to be quite interesting. Today, we've got a few results coming out that we'll be looking at, like REA, News Corp, and QBE, and it will definitely heat up next week as well. But before we get started, just a quick yet important reminder: the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, yeah, you spoke about the interesting week. It was a week of panic in the market, especially last Friday and on Monday as well. And when we're looking at this sell-off, it was really sparked by weaker than expected economic data in the US, including that sharp drop in the manufacturing data and a rise in the jobless rate as well. And these developments really fueled fears of a potential recession and also coincided with other concerns such as the uncertainty around the significant investment companies are making in artificial intelligence. Also, we had the unwinding of the Japanese carry trade, slower economic growth in China, and rising geopolitical risks in the Middle East, which could potentially lead to an oil shock, Jace.
Yeah, that's right, Ken. When things go down, they go down really, really quickly. And as our members know, our managed funds are positioned to protect unit holders from downside risk. The team remains pretty concerned that markets are too optimistic about earnings outlook over the next 12 months. However, we are embracing the volatility that we see in the markets and are ready to seize any opportunities that may be unfairly sold down.
Yes, they say volatility creates opportunity, Jason. Yes,
Mm.
with the reporting season in full swing, there will be opportunities. And but that rise in volatility just reminds us to be vigilant with our portfolios. You know, we've seen valuations that become extended relative to the fundamentals. Inflation is sticky, investors are complacent, and that fear of missing out, or FOMO, and the weight of ETFs have created this highly speculative environment for shares. And historically, we understand that every hard landing begins with a soft landing. So the market looks like it is pricing in a perfect soft landing scenario where interest rates are coming down without a sharp rise in the unemployment rate. So the question on everybody's lips now, Jace, is will there be a recession?
Well, I think that's a question that many people want an answer to. And unfortunately, it's very difficult to sort of judge and come to any conclusions. But right now, many economists are anticipating a 1 in 4 chance of a US recession, which is actually relatively high. However, we believe the recent market sell-off has not been sufficient to align with market valuations, and the fundamentals seem a little bit off as well.
Yes, Jason, that volatility, I believe, will take some time to play out. But at the stock level, we've got margin pressure. That remains a key issue for the reporting season. And you've got inflationary cost pressures still elevated. You've got the RBA keeping interest rates on hold this week as well and suggesting that rate cuts will not begin this year. There is that risk of corporate insolvencies that's going to remain high as well. So when we looked at the July, we saw 5 listed companies going into administration.
Yeah, it seems like financial health remains front of mind as well for these companies, Ken. And, one of the high profile collapses this week was Regional Express Holdings, or REX. This company's been in operation for over 20 years and yet still bit the dust in terms of its share price. Another business that went under is Booktopia, which was a high growth online book retailer that was established in 2004. Other businesses that went into administration include craft beer producer Mighty Craft, work communications platform Lifetiles, and also copper cobalt exploration company Eon Metals.
Yeah, quite a widespread number of companies there, Jason. And over the last financial year, we've seen around about a 42% rise in corporate insolvencies. So that's been significant. And this really reinforces the importance of keeping your portfolio in tip-top shape, removing those financially weak stocks and using this market volatility to replace them with the high quality businesses that could potentially be sold down due to all these macroeconomic risks. But let's turn to some of our stocks highlights for this week. Winemaker and distributor Treasury Wine Estates. They announced plans to divest their commercial brand portfolio, which includes the wines priced under $10. Now, the stock price actually rose on the back of this news. So, was this something the market had already anticipated?
I believe management had previously indicated their plans to revise their strategy regarding some of the lower price brand segments as well. They had long reiterated their desire to focus on premium and luxury, and therefore I don't think the decision was sort of out of the ordinary.
Right. And looking at the numbers, Jace, Treasury Wines is expected to generate positive earnings growth for this year with an improvement in their return on equity. And consensus earnings revisions under Golden Rule 3 over the past 3 months, it's been relatively flat. So will the divestment and subsequent non-cash write-down impact future earnings?
Yeah, that's a good question, Ken. The write-down is valued at around $290 million, and that sounds pretty significant, but the overall impact is less than 5% of the group's total gross profit. So overall, we feel the impact is minimal. Positively, management did reiterate their guidance for FY24 earnings growth.
Right. And let's move on to resources now, Jace. After Rio's first half 24 result, we did reinitiate coverage of the company as a borderline star growth stock. The decision was really driven mostly by the fact that we wanted to keep coverage of key stocks for our members, especially with Rio. Its financial metrics have been sustained despite a volatile economy in China.
That's right, Ken. And you can see under Golden Rule 2 that in recent periods, the return on invested capital ratio has stabilized around the 25% mark despite a fall in iron ore prices. While consensus forecasts a return to growth in FY24, we are cautious that this is driven by commodity price assumptions, which can be rather volatile over different periods of time. So growth investors should really keep an eye out on the 3-month earnings revisions if they want to get any comfort on the company.
And Rio's dividends did come slightly below expectations, Jace, but the yield remains above the market and they are going ex-dividend on the 15th of August. But Dan did comment on why the stock was not able to be included as our star income stock, despite its above market yields, which we encourage all members to read.
That's right, Ken. And as we've discussed many times as well, when it comes to cyclical stocks such as mining companies, investors need to be aware of the active risks, which tend to lean towards volatile commodity prices and also production mishaps.
And now turning to our corporate calendar, Jace, for the week ahead, it's going to be a big week with so many star stock companies reporting their financials. So you'll be very busy, among them we've got a few major ones like Commonwealth Bank, CSL, Netwealth and Pro Medicus. But please refer to the corporate calendar section in Stock Doctor for all this information. In Under the Microscope this week, we take a closer look at biomedical company Neuren Pharmaceuticals. The code is NEU, and the company develops therapies for brain disorders such as Rett syndrome that can affect speech and also hand coordination. Now, as a business that depends on the success of clinical trials, the stock might be better suited to investors who can stomach higher bouts of volatility or those looking for higher impact growth-driven investments.
That's right, Ken. Biomed stocks tend to have higher price volatility, and Neuren's share price reaction this week is an example of that. The company provided a trading update and revised their net sales expectations for Rett syndrome drug debut from approximately $400 million to around $350 million. Now, this downgrade was caused by slower than expected patient add-ons, which is set to reduce group revenue by around $10 million in FY25. Consequently, the company was placed in a trading hold.
Yeah, very interesting there, Jace. And so I guess we will see negative earnings revisions flow through then. But under Golden Rule 2, what has driven that significant earnings growth and rise in return on equity over the past year that led us to think it was an emerging opportunity?
Well, if we were to look under the hood, the company's shift to profitability is primarily due to the approval and commercialization of their product debut. It is the world's only approved therapy for Rett syndrome, a rare genetic mutation that causes loss of coordination and speech, which you mentioned earlier, Kien. Neuren also earns revenue through milestone achievements in sales and also distribution development, along with any royalties ranging from 15 to 20% of net sales. Now, a substantial one-off payment from the commercialization of debut resulted in the astronomical EPS growth over the first half 24 and also saw a strong spike in ROE.
Yeah, incredible, Jace. That explains that rapid rise in return on equity to over 100% over the last period. But Jace, why is return on equity forecasted to now decline drastically under Golden Rule 3, the outlook?
Good question, Ken. And sometimes good things have to come to an end. Analysts do expect the ROE to decline because the business is transitioning to more routine royalty payments and potentially smaller milestone payments moving forward. Bear in mind, there are 6 analysts contributing to the consensus forecast, so this is something that investors need to be mindful of.
I see. And under Golden Rule 4 as well, I noticed that the stock price has now triggered an exit on our stop loss indicator, the SD30 TSR. So trend-sensitive investors should remove the stock from their portfolios. I also noticed that short interest has been ticking up since the start of the year, although it's not above that 5% threshold we consider as a red flag.
Neuren's share price is currently trading at a substantial discount to the consensus share price target. This might represent an opportunity for certain growth investors who retain a longer-term view on the company's growth prospects, but you do really need to understand the active risks involved in investing in a biopharmaceutical business.
Now for question of the week. With the risk of a hard economic landing on the rise, an interesting question this week is, what stocks tend to perform better during an economic contraction or a recession?
Well, it's a good question, Ken. Generally, companies with defensive cash flows and earnings that are not sensitive to the economic cycle tend to perform better during periods of contraction. Now, these stocks could come from consumer staples, utilities, and also the healthcare sectors. You can see it with the chart on screen. This research indicates that the average return and hit rates of sectors that have outperformed during a recession have tended to average around 10% over these periods. Now, amongst our star stocks, our healthcare exposures include Cochlear, ResMed, CSL, and Pro Medicus. Within consumer staples, we've got Endeavour Group, Ridley Corporation, Treasury Wines, Coles, and Woolworths. And within utilities, we've got Star Income stocks, Telstra, Spark New Zealand, and also APA Group.
Yeah, very interesting list of stocks there, Jace, and we look forward to their results in the coming weeks. But although this is quite interesting to know, the reality is that timing the market based on economic cycles is quite dangerous. Instead, investors should really be focusing on the risk management of their portfolios.
That's right, Kien. Balancing your portfolio based on macroeconomic factors are actually quite difficult. So the best thing is ensure you have a well-diversified portfolio of high-quality stocks with strong financial health and also cash flows to help them ride through any economic challenges. Remember as well to take profits, accumulate a bit of cash, and use that cash to fund any opportunities on the back of the market volatility.
And definitely with reporting season now here, there's going to be plenty of opportunities. But I know you're very busy, Jace, with the announcements, but I appreciate your time today.
Look, it's always a pleasure to be here, Ken. And if members have any questions about today's episode, please feel free to participate in our Lincoln Live webinar every Monday.
And also, we will be conducting a virtual masterclass event later in October for those who were unable to attend our event in Sydney and Melbourne earlier this year. So remember to register your interest there. And you would have also noticed that we have a referral program that's up and running where you have the chance to go into this draw to win the ultimate Penfolds Winery Escape. So our business is driven by our members, and we do appreciate your ongoing support and loyalty. In the meantime, have a happy, healthy, and prosperous week ahead.